Hello everyone. Thank you for joining us for the May edition of Market Compass. Today we are looking at the Federal Reserve and the bank's interest rate policy. As we think about what drives investment performance over the long term, it's economic growth, corporate earnings, and interest rates. The latter has been at the forefront over the past year as the Fed has hiked rates aggressively to tame inflation. But after having done a lot in a short amount of time, we are potentially at a turning point. In early May, the Federal Reserve raised interest rates by a quarter point, bringing its policy rate to slightly above 5%. To put into perspective how sharply rates have adjusted higher, up until March of last year, the Fed's policy rate was near zero. So we have seen a 5% rise, which makes this tightening cycle the most aggressive in 40 years. But we have some reasons to believe that the May hike might be the last. To begin with, the Fed softened the language in its statement, omitting a line that said some additional policy firming may be appropriate. Given how policymakers prefer to communicate, we view this as a strong signal that the Fed is indeed preparing to step to the sidelines. Of course, any change hinges on the path of inflation, and we've seen some progress on that front. The most recent CPI reading showed that consumer prices slowed to below 5% in April for the first time in 2 years, which we think gives some room for the Fed to pause. Historically, the Fed has never ended its rate hikes before its policy rate exceeded the rate of inflation. But with headline inflation now at 4.9% and the Fed funds rate slightly above 5%, a June pause would not break that precedent. Also, with the recent stress in the banking system, banks are less likely to lend. And this could weigh on economic activity and inflation, in a way doing some of the Fed's work for it. As an investor, you might be wondering what comes next. We believe the Fed will keep interest rates steady in the months ahead. But a pause doesn't mean rate cuts are coming soon. Inflation is still way above target, and the economy has proved to be resilient, supported by low unemployment. As we get closer to the end of the year, we could see discussions about rate cuts starting to emerge. By then, we expect some economic softness and a more meaningful improvement in inflation. Historically, once inflation peaks, the pace and duration of declines have largely matched the pace and duration of the prior increases. That was even the case in the 1970s and 1980s. Given that so far we are following the same pattern, we think there is a good chance that inflation could fall to around 3% by the end of the year, which would be a significant accomplishment for the Fed. What does all this mean for investors? For over the past 40 years, a Fed pause has been a positive catalyst for balanced portfolios that include stocks and bonds. Historically, after the final interest rate hike, policymakers held the rates steady for about 6 months on average, before cutting them to stimulate the economy. From the last Fed hike to the first rate cut, stocks performed strongly in 5 of the last 7 cases, while they declined only modestly the other 2. Investment-grade bonds also experienced above-average returns, as yields peaked a couple of months before the last rate hike. With the May policy decision likely marking the end of tightening, we believe that we have seen the peak in the 10-year yield, which rose as high as 4.25% last year. Today's high interest rates are not going to last forever, given the gradual shift in Fed policy. We think investors, where appropriate, could consider locking in the historically high yields in short-term fixed income. But we also see an opportunity to add longer-term quality bonds. These bonds not only secure high income for longer, but also may appreciate if yields eventually start to move lower if the economy slows and the Fed begins cutting interest rates down the road. We believe you can expect more volatility in the months ahead as the economy slows, but we also think balanced portfolios can continue to rebound following last year's decline. Keeping a long-term perspective is important, especially when equities are still some ways off their highs. A Fed interest rate pause won't be a cure-all, but we believe it will be an important step towards a more sustainable recovery. With that, thank you for joining us for this month's Market Compass. We hope to see you again next month.